my cursor as well, because I'm going to be using that. Yeah, okay. Ankit at Indiana, and who knows where I'll be in a year or 2 or 4 or whatever. Okay, so I'm going to start this off with a quote from a very influential person. I want to be very clear about this. So we're not going to directly contradict the statement that's about to be made, but I am putting it up there for 2 reasons. Okay, so this is Elizabeth Warren, and it's actually very ironic, the timing of this. So a day before, literally 1 day before the first time we presented this at a brown bag in DC, Elizabeth Warren made a quote that said in a speech that ride-hailing companies like Uber and Lyft are undermining the economic safety net of worker protections built over the last century. Okay, so she's basically arguing that, you know, if you are a gig labor worker, you're not going to have the ability to organize, union protections, things like that. And that's a fair statement. That absolutely is. I put it up there for 2 reasons. One, I just thought it was a little poetic, the word that she used, safety nets, because we're going to view gig economies and ride-sharing companies as a, you know, being able to offer a different form of a safety net. And the second one is, and I think this is what this quote kind of exemplifies, there have been numerous political actors in the media that has looked at ride-sharing companies and the gig economy as being a bad thing for individuals. And I am not going to be able, we're not going to make any welfare statements that on average for everybody, welfare improved. But I just want to point out that, you know, the majority, if not all of the existing kind of attention has been on the negative sides of the gig economy. What we're going to show is something that's going to sit on the other side of the ledger. Something on the, that's going to, now I'm not going to say it's going to balance it out completely, but it's something that we're basically going to think of the gig economy as providing this really important positive aspect that hasn't really gotten the attention that the negative has, okay? So if you think back to, you know, our intro micro class, what's one of the first things you learn? Well, you learn error to prove securities. And the point is that individuals prefer to be able to smooth consumption. They want a smooth consumption stream over a lumpy one, right? This is something that kind of builds up the foundations of life cycle models. And so if you think about the perspective of a household, when is this ability to smooth most important? It's when you have really extreme shocks to income. You really want to be able to buffer those things out, because this is where you are on the steep part of your utility curve, right? That's where for a person's like lifetime consumption, this would really matter the most. Okay, so the setting we're going to study is one that is the perfect example of when you have an extreme uncertainty in your income shock, and that is the time around which a person is laid off from their job. Okay, they experience a job loss. Now, at the same time, if you think about what's happening in these job losses, there are typically 2 responses that we can think of. So the first is that the person can claim unemployment insurance, right? This is kind of one of the foundations for this, is the ability to kind of, for people to consume in a steadier fashion, to kind of, you know, spread this out to buffer this like unexpected shock. And the second is for people to kind of draw down on their credit. So tap into unused reserves, use their credit card a little more, still be able to put food on the table, they'll pay off the balances later. Now, if you think about both of these responses, they're half measures, right? What would a person really want to do? Well, once they get laid off, they want to be able to snap their fingers, get a new job, be placed at a new firm, exchange labor for income, and just go on their way. Now, because there are frictions in the labor market, they can't do that, and so they turn to one of these other things while they look for reemployment. Now, the reason why I call them half measures, both have a negative consequence, right? So there's a pretty good literature in the UI talking about how social safety nets like unemployment insurance can dampen incentives to find reemployment, right? If you think about credit, the financial crisis kind of taught us a lot of implications of increasing household leverage. Me and Sufi kind of like led the charge in this area. Asaf Bernstein has a really cool paper on debt overhang for a household and like seeking employment. Okay, so neither one of these things is ideal. So what are we going to think about? Well, we're going to think about what happens if you can ease those search frictions to find that temporary job to replace or to exchange labor for income while you do look for a long-term job. Okay, so this is one, and the shock we're going to use that's going to ease the search friction is the introduction of the gig economy to an area. So the question we're going to have is, does the intro of Uber into an area affect a worker's response to job loss? Now, I meant to say this earlier on. Cindy put up some really great questions in the Slack channel. One of the reasons why I love them so much, we're going to be able to, I'm going to have two specific answers to two of those questions I'll get to towards the end of the talk. Okay, so anecdotally, we do see evidence the gig economy has been utilized during job loss. So during the more recent government shutdown, there was a lot of concern of air traffic controllers having to moonlight as Uber drivers, and they'd be tired during their day job, during the furlough. And this is a New York Times article about a federal worker basically turning to Uber to support herself and her granddaughter while she was furloughed. Now, this isn't the first time that people have kind of thought about this idea of going to work at the gig economy. In 2013, before Uber was even around, you had another government shutdown. And so this is a tweet from an executive at TaskRabbit that said, totally organically, during the week of the shutdown, we had 13,000 applications in a single day. Huge record. So the idea of when people suddenly didn't have access to their money, they were furloughed, that you're going to turn to this quick, easy access job that you're going to be able to exchange labor for income. Okay, so nice anecdotal evidence. So what are we going to find? We're going to find that following Uber's entry, we're going to see what we think is a pretty significant reduction, in terms of, and I'll talk about in a minute why I think it's significant, a 5% reduction in your likelihood of reducing UI claims once Uber is there. We're going to see effects on your credit balances. So the untapped credit, you're not going to increase balances by as much, $500 or so. But at the same time, credit worthiness is going to be helped out. You're 3% less likely to go delinquent on either a home loan, a credit card loan, something of that nature following Uber's entry. Okay, now challenges to identification. This is a kind of a tough thing to do. You may be worried about kind of differential access across workers. We're going to have one way to sweep that out with an individual fixed effect, maybe time invariant differences across CBSAs. Where Uber entered, we know Uber entered into major areas first. So maybe these are inherently different and we're just loading up the sample with a lot of those. We can sweep that out with another fixed effect. The one you're probably thinking about is, was there pre-existing trend? Uber strategically entered one area that was, for some reason, benefiting people that are about to be unemployed because labor markets are tightening or something like that. We're going to be able to show that there were no pre-existing trends, so we don't really find any evidence for these challenges. Okay, so this broad literature this is related to, I'm not really going to go into all of it. You have a lot of heavy hitters in the unemployment insurance literature that we can kind of speak to. You have Mead and Sufi's work, along with others on the household credit through the financial crisis, the intersection of these two, and then a budding literature on the gig economy. Okay, so apologies if I didn't cite a paper you particularly like. There are tons of them, and so there was not enough space. Okay, so to give you a roadmap, we're going to talk about the data a little bit, then get into the results pretty quickly. So we are going to use two data sets. The first, Uber entry dates. So this was provided by somebody at the company, right? We didn't have to go hand collect these and worry about measurement error. So this is all product rollouts from the initiation until March 2016. We're going to focus on UberX because this is the one we think when you are laid off, you get more of ability to drive using a Toyota Corolla than if you needed a Lincoln Navigator, for instance. And then we're also, if you think about like what's the coverage, 163 areas. Now, one thing you may be worried about is, well, these things probably all happen at one point in time. And so if you're going to do some kind of diff and diff, you really have one observation. So this is the distribution of timing of Uber's entry across areas. And actually surprisingly when I first saw it, it's relatively dispersed. You had the initial two pilot phase or pilot areas, and then you had a lot of rollouts between mid 2013 all the way until mid 2016. So we're going to have a lot of time series variation that we can try to tease out effects and worry about like pre-existing trends that this is going to aid in. Now this is just across the US. Well, where did Uber enter? right? This is the first time Uber entered the area. It's not surprising. It entered on the coasts first, right? New York, San Francisco, then throughout the rest of the U.S. Texas sits kind of roughly in the middle of when it entered. And so if you take nothing else away from this presentation, just think of that fact, right? This is like my lifelong goal, is to mention Texas in as many presentations as I can. And so I just serve that purpose, just check that box. Okay, so what are we gonna interact Uber entry dates with? Well, we are gonna use individual level data on job separations, unemployment insurance claims, and credit outcomes, all provided by Equifax. So they link these things internally. That's going to give us a really good match of a person's kind of credit history, which we're going to utilize. If they were laid off, and I'm going to focus on layoffs specifically, not just a job loss, and if you filed for unemployment insurance. So if you think about like the time series of what this looks like in our data, this is our variation. So you're going to notice this big spike in January 2013. So essentially, the reason why we have this spike is because this is something employers are going to self-select into. They're going to contact Equifax and have them do the back operations. It's like the State Street of UI claims. Okay, now the reason why you see this big spike is right around this date, there was a new law put in place that basically said for a company, if an unemployment insurance agency, Texas, it's the Texas Workforce Commission, if they contact the company to verify information about a person filing a UI claim, and that company does not respond in a quick and appropriate fashion, the company can be held liable and they can be fined. And so companies don't want to deal with all this hassle, especially now that they can be held liable for this. And so they basically outsource all these operations to Equifax. Okay, so for any company who self-selects into this, they're going to give information continually about their employees, about people that are laid off. And in this, they're going to have the reason why they are laid off. And so this is going to give us the ability to actually isolate people who are laid off for reasons eligible for UI. So lack of resources, lack of capital, not the person didn't show up for their job. Okay. So this is kind of this is the spatial variation in this, scaled by job separations. So we're going to see it's relatively evenly dispersed across the US. There's a couple concentrated points. Nevada, I believe, and my geography is terrible, I believe this is Delaware, the little squiggly one, or Maryland. No, that's Maryland. So, but for the most part, you have a pretty good variation across the US, or pretty uniform in this in some sense. Okay, so how are we going to construct a sample? We're going to start with all 20 million or so things that we quantify as a layoff, right? Ones in which the person did not lose the job of their own accord. It was something that they would qualify for UI. We're going to randomly sample 1 million of these jobs because for computational purposes, we run all these things on the servers at Equifax that are pretty heavily taxed, and we can't do it on our full sample. And then from that 1 million, we're going to restrict to the time periods where Uber entered between January 2011 and December 2016, which is going to give us a 12-month lead and lag time around Uber's entry. And then we're also going to restrict this at this point to places in which Uber at some point in our sample entered into this, because ultimately we're going to be using a diff and diff approach. And we think it's appropriate to measure the effects in Boston where Uber's entered relative to, my hometown, Gainesville, Texas, where Uber will never enter because it's too small. Okay, so we're going to keep this as apples to apples as we can. I'll talk a little bit about that later. Okay, so what is our empirical strategy? I've already kind of mentioned the diff and diff. Well, just to start out, let's think about this. This is not what we're going to do, but let's think about kind of the staggered entry of Uber across different geographies. So if we want to estimate that staggered entry of Uber on different areas, it gives you a nice diff and diff. So your left-hand side is going to be some kind of outcome variable. Maybe it's your likelihood of applying for unemployment insurance. On the right-hand side, we're going to have uninterrupted terms, the fact that you were laid off, the fact that Uber entered into your area, and then what we want to think about is when you get laid off, are you less likely to file for unemployment insurance once Uber enters your area? So this is going to be an indicator that takes on a value of 1 if Uber is operating in your area at that point in time. And so in this regression, we can actually put in a time fixed effect, and we can also, that's going to be, vary across all observations, and we can put in an area fixed effect. And so in this sense, we're going to sweep out the uninteracted Uber term, right? Because we can put in a fixed effect for an individual place at a point in time. Okay, so that is a kind of a good starting point to think about. The identifying assumption, if you just use that, is that Uber's entry into an area is going to be uncorrelated with some other observable factor that would influence, your likelihood of filing for UI or increasing your credit usage once you get laid off. So basically, that this term is not going to be correlated with something else that's going to influence the loading on being laid off. Okay, so if you think about the timing of Uber's entry, you may think that's a defensible statement, right? We know that Uber's entry is basically related to population sizes and cell phone penetration. Greg Buchuk has this kind of in his job market paper, and it's something we verified on our own. But we're not gonna rely on that. What we're gonna do is we're gonna go one step further, right? And so if we think about this, the effects of Uber's entry, it's gonna be concentrated, specifically on that group of people that's most easily able to work for Uber if they're looking, like when they get laid off. And who's that going to be? Well, those are people who own cars when they get laid off, right? So it's not going to be somebody who doesn't own a car and they lose their job, because it's very unlikely they're going to go out and buy a car just to drive for Uber once they just lost their job and they have no income and no way to kind of purchase that vehicle. Okay, so what we're going to do, we're going to infer or car ownership from our credit panel. We're going to look for an auto loan or lease between 2006 and the month prior to your job loss. So we are going to abstract away from people who are strategically buying cars when they get laid off to work for Uber. Anecdotally, or in untabulated tests, we don't find evidence of that, but our construction of a car owner isn't going to be contaminated by that if you are worried about it. Okay, so now what we're going to do is we're going to think about the differential effect for these car owners once Uber enters their area. So our double diff becomes a triple difference in difference. And what we're going to think about is following Uber's entry into an area, your response to layoff, and how this differentially, how this is a differential treatment on people that own a car versus those who don't own a car at that point in time. Okay, so now the identifying assumption becomes a little bit tougher to tell, a potentially alternative story, right? And this is that Uber's entry into an area is uncorrelated with something else that would differentially affect a person following a job loss that happens to be a car owner relative to a person who's not a car owner, okay? And I'm gonna come back to this identifying assumption in a really nice secondary test we can do that you may be worried about differences for people who own cars versus people who don't own cars, okay? So what are our results? Well, we are gonna consider 3 things: UI uptake, credit usage, consumption, if you will, and performance on credit, so delinquencies, right? So our triple interaction is going to capture pre and post job separation effects, all right? For an individual person, we're going to have an individual fixed effect. So this is all within person variation once they get laid off relative to before they were laid off. We are going to, the interaction is going to pick up, differences across areas based on when Uber entered. We're going to have that an MSA by month fixed effect that's going to completely sweep out Uber's entry into an area for the local economy. And then we're going to have an owner an owner indicator that's going to have differences for car owners relative to non-owners. And we care about that triple interaction to think about this differential effect. So we're going to start with UI uptake. And so, perfect. All right, so these are in percentage points. And so the way you want to interpret this is following Uber's entry, a person is 28 basis points less likely to file for UI in a given month if Uber is in their area and they own a car, relative to car owners before Uber enters and relative to after Uber enters for non-car owners. Okay, so if you think about this, 28 basis points is really hard to kind of think about, well, what's the economic magnitude? In our sample for a car owner, following layoff, you are 5.8 percentage points. That's their likelihood of filing for UI. And so this is going to represent roughly a 5% relative effect on that. Okay, you can also look at the amount you receive if you do get UI benefits, just the dollar amount across all individuals. You're going to be $2 less in terms of overall UI benefits. This is one that we don't focus as much on because in some sense it's going to be mechanical. If you are filing for UI, you're going to get your max benefits potentially, right? We don't expect those max benefits conditional on getting UI to change across these two. And so this is just kind of a secondary test to reassure us that you are in fact less likely to get UI insurance. Now you may think about this as, well, 5%, that seems like a relatively small thing. Now this is one of the things that if you think about our test, it's in some sense a second stage. So we are looking at the average effect across all car owners following layoff. Unfortunately, we don't have the data to know, well, what percentage of those people are working for Uber, right? So if they are working for Uber, you would expect them in some sense to, they can't file for unemployment insurance. So for all people who actually do take up that job, then they would definitely not file for unemployment insurance. This is the average effect across everybody, not knowing exactly how many of them are filing or are working for Uber, okay? Okay, so you may be concerned about pre-existing trends. What if Uber is strategically entering areas that are experiencing tightening in labor markets or loosening in labor markets that would affect your likelihood of filing for UI? So what we're gonna do, we are gonna examine the effect instead of looking at, instead of looking at this triple interaction of being laid off and being a car owner once Uber enters, we're gonna replace this last term with a set of dummies basically capturing the event time around Uber's entry. So we're gonna look at the 12 months pre and post Uber's entry, a monthly interval, and then we're gonna stack all the extra observations on the endpoints. So that's gonna capture everything before 12 months and everything after 12 months. So this is that previous regression in a graphical form. If you think about the loading of layoff by owner and how it kind of varies across Uber's entry. So you don't see any pre-trends, you don't see any real declines going into this. The month in which Uber enters your area, that's when you are less likely to file for UI following a layoff if you're a car owner. So the effect materializes immediately. So it's really hard to argue this is a pre-existing trend, given that Uber is going to strategically, they're not just going to say, all right, we need to go into a new market today. What's a good market to go into? They plan these things out months in advance. So unless they have perfect foresight of changing economic conditions in those areas, it's really hard to argue a pre-existing trend story for this. Okay, the second concern that you may be worried about, what if inherently car owners are different than non-owners? And this is just a broad trend, and this is something to do with, changes over time in large areas versus small areas. And so what we're gonna think about two people who have access to a car. So what we're gonna specifically think about are those who have an auto loan versus people that have an auto lease. Both have access to a vehicle. Now the big distinguishing factor is if I have an auto lease, there are typically mileage limitations written into that contract. It's like 9,000 miles a year a lot of times. And so it's gonna be really difficult for me to drive for Uber and use this as a commercial purpose if I have this auto lease. In fact, a lot of leases say you can't use them for commercial purposes. So we're gonna distinguish between people who have an auto loan or had an auto loan versus people who had an auto lease within their, within their structure. It's not that you currently have one, but it's that the car that we matched you with, between 2006 and now was an auto loan or an auto lease. So when we split our test for auto leases, without auto leases, the effects get stronger. If you look at people with an auto lease, you don't really see an effect. Both of these are people who have access to a car, but if you have an auto lease, it's gonna be really difficult to drive for Uber and not go over your mileage limits and have really, really high costs. Okay? Now, that was for unemployment insurance. At the same time, what we've kind of learned through the financial crisis is that increasing household leverage has a lot of implications, especially for the propagation shocks through a local economy. So we're going to think about credit utilizations. Okay, so if you look at just average balances on your credit, you're going to see a relative reduction. If you have, a car, if you're a car owner, once Uber enters into your area of $500, this represents, roughly a 2% relative to the average, credit balance of a person in our sample, which includes a home and things like that. Okay, we're going to see a lot of this concentrated in home loans. We don't really see an effect in credit cards, and one reason why you might expect this is if I am working for Uber, I actually may increase my credit usage during that time period on a credit card because now I have additional gas payments. I'm using a lot more gas and things like that could offset some of this. Okay, so at the same time, while this is just credit balances, I think something we would care more about is, well, your credit worthiness. Like the idea of the financial crisis was, delinquency shot through the roof. Moral hazard just went, it just became a very big deal. And so if you think about delinquencies, we're going to see a 50 basis point relative reduction in delinquencies for a household if they have a car once Uber enters. And this is a roughly 3% relative effect across the overall, average of having a delinquency, which is about 17%. Okay, now there are two potential channels that you can think about. I'm kind of running out of time, so I won't hit too much on this. Either Uber views this as a short-term alternative while they seek employment elsewhere, which would represent a structural shift in the way we think about job search, or they could actually treat this as a permanent job. This is just another big employer coming into your area. Walmart opened up a new supercenter, and now there's just more jobs available. So we can actually get at this in a couple different ways. So the first, we're going to remove the period immediately after Uber's entry. The idea being, if it was a big employer coming in, once they accumulated all those jobs, they hired all those workers, the effects should dissipate. So we can toss the 2 years after Uber's entry for each area. The effects stay virtually the same. We can also focus on high-income individuals. So if you live in an area, a zip code with $90,000 plus household incomes, we still see an effect. And this is the group of people you would think it's unlikely they're going to take their normal job, throw it out the window, not look for another high-paid job, and just drive for Uber for the rest of their life. Okay, so even for this high-income group, we're still going to see some effects. Okay, and then the final one, this is one I'll show in here, is we're going to exploit heterogeneity in UI benefits, which if I'm viewing this as a short-term option while I look for work, this is the outside option. Instead of driving for Uber, I could just file for UI claims. Now, what we're going to use is variation across states and the maximum allowable limits in UI caps. Okay, so in Massachusetts, you can get up to $680 per week. In Mississippi, you can only get $235. And so if you split this into states where there is below versus above median generosity and benefits, you're going to see much stronger effects in the states where UI benefits are very low, right? Where that outside option isn't as attractive. Okay? Okay, this is for both the UI uptake as well as credit balances. All right, so in conclusion, right, we examine the impact of Uber's workers' response following Uber's entry into an area. We find you're less likely to file for UI. We find you're less likely to go delinquent on your credit, right? Preliminary signs of the effects are stronger when UI benefits aren't as great. In one of the tests I didn't get a chance that Cindy kind of mentioned, you may worry about this being pro-cyclical, or sorry, counter-cyclical, where it basically performs well when the economy is doing well, and it doesn't perform well when the economy is doing poorly. I guess I'd make it pro-cyclical in terms of its benefits. So while we can't speak to the current crisis, because clearly nobody wants to ride in a car with others when you have COVID, we do one test where we look at areas that had a local increase in unemployment in a 6-month period, and we actually find the effects are stronger in these areas. So when you have a local recession within our sample, we actually do find stronger effects, consistent with bigger fear of finding another job, and the attractiveness of Uber goes up even more. Okay, so overall, we do think this is evidence that the gig economy has made a significant change in the labor market, specifically in how workers respond to job loss, which is really important from a policy standpoint. So thank you very much.